Happy Friday, everyone. As you can probably see from the buildings behind me, I am not shooting in Spokane this week. So welcome from Chicago. This week, we're going to talk about why you should not let politics influence the decisions in your portfolio. All of us at 10 Capital have been getting a lot of questions recently from clients around what is going to happen in the midterms. Are the Democrats going to hold the House and Senate? Is there going to be a red wave? How is it going to affect the portfolio and markets moving forward? And we're noticing a consistent theme. There is a lot of fear around what is going to happen and what is that going to mean for the economy and the markets. So instead of worrying about those feelings and what we think is going to happen, I thought this week would be a good opportunity to look back at the history of midterm elections and how the markets have fared both through the midterm and then fast forwarding 6 and 12 months. So you're going to see a chart that pops up here in a moment, and it actually paints a picture that's a little different than maybe what you would have thought. So going all the way back to the 40s, from the day that the midterms occurred, whenever that would have been in that early November timeframe, and then fast forwarding to June 30th of the following year, you'll see a theme. Regardless of what happened in Congress, whether Congress stayed aligned with the president, whether Congress flipped, regardless of what happened, markets have been positive June 30th of the following year post-midterm every time since the 40s. And it does make sense when you look at that data. You tend to get a lot of negativity going into elections, and there's a lot of fear around what's going to happen. And in the short term, markets are driven based off of how consumers feel and how investors feel. Now, usually, and again, these are my words, but usually when you get through an election cycle, people tend to take a breath, and sentiment tends to be a little more positive post-election. That is, in my opinion, why we've seen, going all the way back to the 40s, positive returns 7 or 8 months post a midterm election. And another chart that I'm not going to show for this video, but just to kind of back up some of that data, from the 50s, post-midterm election, if you fast forward 12 months, the market has been positive every time. And the US stock market has averaged 9% in the 12 months following every midterm from 1950 on. So that does not mean that this time couldn't be different, but we can't let our feelings dictate how we should look at the fundamentals of not only the market, but of your portfolio. Trust me, we've certainly been keeping an eye on everything that's happening in the economy with inflation and a supply chain that is still trying to get back online and the Fed raising rates. But what we're not going to do is start making portfolio decisions based off of what we think will happen in a political environment that is emotionally charged. Obviously, we're keeping an eye on the areas of the economy that we think are important to us when it comes to the construction of portfolios. But I will tell you, the political environment is not one of those factors that goes into the decision making. And as we talked about today, I think history backs up why we know how you should be invested. And if you're in a portfolio right now that is built around your financial plan or your individual situation, speculating on what is going to happen in a midterm election will not be the ideal way that we achieve those long-term goals that each of you have. If you have questions, as always, don't hesitate to reach out to one of us to talk through your individual situation or get our thoughts on not only how we're viewing the economy right now, but where we see markets going potentially in 2023. So goodbye from the Windy City. Hope you have a great weekend. We'll talk to you soon.